Let us start with a little bit of uncomfortable truth. Some of the most powerful market signals are not new. They're not complex. They're not fashionable. They are ancient. What you're looking at on the screen is the gold to silver ratio, tracked continuously back to 1869 and conceptually back more than 5,000 years, making it the oldest continuously observed exchange relationship in human economic history. Again, we're looking at the ratio, a relative number, not an absolute. So the chart is not about gold, it's not about silver, it's about fear, liquidity, confidence, and monetary stress. And today, this ratio is flashing a signal that investors have learned repeatedly to ignore. Let's start by explaining exactly what this chart is telling you. Because misunderstanding it leads to disastrous conclusion. The gold to silver ratio answers one question. How many ounces of silver does it take to buy 1 ounce of gold? If the ratio is high, then gold is strong relative to silver. So now here's the key insight for most people miss. Gold equal what? Monetary fear asset. Silver is monetary but also industrial growth assets. Why? Well, because you don't use gold in anything, it's too soft. But silver, on the other hand, is used for lots of industrial applications. So when the ratio rises sharply, investors are abandoning growth exposure. Liquidity is tightening and risk is being repriced. The economy is under stress. When the ratio rises, meaning gold is strong to silver. When the ratio collapses, growth expectations return. Meaning what? Well, we're going to grow, so we need silver. Industrial demand revives, liquidity expands, and risk appetite recovers. So remember, silver is industrial, gold is monetary asset. This is history. It's not opinion here. I'm just telling you exactly what we're seeing. Nothing to do with me. So the stable money era from 1869 to 1914, right, on the left, you could see the chart, the ratio going up. In 1869, the ratio sits around 15 to 1. That random is not random. For centuries, monetary system naturally anchored the gold-silver relationship between 12 and 16. Reflecting scarcity, mining costs, monetary circulation, industrial demand. This is the gold to silver ratio. Remember, we take the price of gold and we divide by the price of silver. And this was the 1869. This was the era of sound money, hard settlement, limited leverage, low financialization. Volatility was low because money itself was stable. 1930. Look at the spike from 1930. What's going on there? Well, the ratio is surged upward of 98 to 1 by 1939. Why? Because silver collapsed. Because policy intervened violently. Gold was repriced by executive decree. Just want to remind my subscribers and my members that in 1933, what happened in 1933? The government forced, some of my members said that they basically stole the money. No, the government didn't steal the gold. What the government said is you have to tender all your gold that you have at $20 an ounce. That's what happened in 1933. And when they did that, shortly after, the government repriced gold to $35 an ounce. So you could imagine that people were pretty upset, but there was a whole history behind the fact that they wanted to take that gold from the people by basically repricing the dollar. But we'll explain that later on. But there was a lot of deflation going on. So during that time, gold surged as a store of sovereign fear. Silver lagged because industrial demand collapsed. This is the first lesson. Gold to silver spikes are not bullish signals. They are distress signals. You could see where we are today. I mean, let's not get there, but look at the chart to the right. So then, of course, came Bretton Woods with the artificial stability. From 1941 onward, the ratio trends lower. Why? Because the global monetary system was artificially pegged. Now, I want to remind you all that what happened during Bretton Woods, this was the end of the war. The Russians, the English, and the Americans got together and they say, okay, what is going to be the new world order? And basically, they looked at the English and they said, well, now you're old schooled. It's going to be the U.S. And this was the dollar became the reserve currency. I mean, at that time, the U.S. won the war. So the system was artificially pegged. Gold-anchored currencies. Capital flows were controlled. Volatility was suppressed. What I mean by currencies, basically what they did was they pegged the dollar to gold. They say, fine, we'll make it the reserve currency, but, gold has to stay behind the dollar because it's the only piece of paper at the end of the day. I say, sure, let's do it. And of course, I don't have to remind you what happened in 1970 when Nixon said, you know what, remove the gold, let's just run it by itself. But that's a different story. So this 1945, this was engineered stability, not organic equilibrium. The ratio declined not because risk vanished, but because it was forced underground. And of course, in 1971, mentioned before, right? See, are we collapsing there? In 1971, one vertical line, one structural break, the US dollar is severed from gold. From this moment onward, money becomes policy. Credit replaces savings, leverage replaces productivity, and volatility becomes structural. You need to understand that when they removed the gold from the dollar, they, meaning Nixon, this was a bold move. This was akin to what the U.S. did this year with this huge amount of tariffs. They say, this is not going to work. You're going to create inflation. Everything is going to collapse. And it did for a while, but then the stock market, right, last year went down quite a bit. But then they say, but everybody's going to be upset. They're going to basically pass on the cost to the consumer. But forget that. The other countries are going to react and they are going to price you out. And you're going to have a trade war. And you did not have a trade war. And inflation really didn't go out that high. It was a ballsy move, but it seems to be working. Now, of course, it depends which side on the aisle you're in. You're going to say, well, there's a lot of inflation going on. Yeah, but for those that could afford it, it's manageable. And it's not everywhere. The only thing is that the market collapsed for a while, but it recovered. So it worked. And this is exactly what happened in 1970. When Nixon did that, they said, this is never going to work, and it did work. And that's when the U.S. really became a superpower. So at that time, in the 70s, the gold-silver ratio became free to signal reality again, and it does, violently. See how it reacts? So now, post-1971, the volatility regime, from 1970s forward, the ratio becomes unstable. Spikes becomes larger, mean reversion becomes slower. You revert to the average, and extreme becomes more frequent. Why? Because fiat systems amplify the stress instead of absorbing it. Each major spike corresponds to recession, crisis, credit deterioration, liquidity, panic. This ratio does not predict timing. It diagnoses systemic stress already underway. That's what it does. Look what happens in 2020. The ratio explodes to 125 to 1, the highest level in modern history. This was fear, right? I mean, we're going to be basically, and don't forget, and this is why I want for my subscribers, and I want you to join, because what we do on a daily basis, we talk about these things, and I tell you what I'm doing to take advantage of it, because right now we're pretty high. And there are ways for you to take advantage of this. Now, this is not inflation. This is fear. Gold was hoarded. Silver was abandoned. Industrial demand collapsed overnight. That was not bullish. This was systemic trauma. 2024. The unfinished story, right? Now fast forward to November 2024. The ratio sits around near 84. That is not normal. That is not equilibrium. That is a late cycle stress. Despite equity indices near high, we know there's volatility is suppressed. AI optimism is basically the narrative. And this ratio is telling you liquidity is fragile. Growth expectations are hollow. Risk is mispriced. Historically, this level only persists when something is unresolved. Look at the chart. We are very high. I mean, we're not 2020 high. But we're high. The ratio I'm talking, this is a ratio, remember. And a high ratio, what does this, so does this mean for investors? It does not mean buy silver tomorrow. Gold will outperform forever. What this says is the system is unstable beneath the surface. This channel is not about telling you, look, it's going up, buy, it's going to go higher. Because no one knows that. But when you're crossing the street, I'm telling you, look left and look right. High ratios of gold to silver mean capital seeks safety, not growth. Industrial demand is weak. Credit cycles are tightening. Monetary credibility is questioned. Of course it's questioned. Look what's going on with the Fed. They're telling the Fed that you're lowering the rates, but are you truly independent? Look at the 10-year yield. It's higher than the Fed fund rate. It means that the treasury markets do not believe what the Fed is doing. They believe there's an inflation popped into it. And I'm going to do a video on inflation to show you. So historically, these pairs resolved in only two ways. Two ways. Growth collapse. Silver stays weak, and reflation shock. Silver violently catches up. But what never happens is a soft landing. So, in closing, I will say this. The gold-silver ratio does not shout. It does not trend on social media. It does not care about the narratives. It has outlived empires, currencies, governments, central bank. And right now, it's telling you this system is under strain, whether markets admit it or not. So, ignore it at your own risk.